I want to go to Ken Fisher right now. Over the years, I've been blessed, given the job I do, to talk to some of the finest brains in the financial world, and I certainly rank him up there with that, not only because he's become a billionaire many times over, zigging when others zag, but he's also been a very calming presence in the middle of craziness in these markets and correlations that we seem to buy that aren't always so picture perfect or reliable. Ken Fisher is the founder, executive chairman, co-chief investment officer, Fisher Investments. And Ken, very good to have you back with us.
Thank you so much for having me back, Neil. It's great.
Same here. So, Ken, I read a lot of your writings, and not too long ago you were looking at this correlation between rising rates and how the markets perform. And I was a little surprised to discover that for the most part, the markets not only hold up, they go up. It's not 100%, but it's a much higher percentage than I thought. So why is that?
So first, what is abundantly clear, which is that the correlation between rising rates and stocks is actually positive, not negative, whereas the mythology is they're negative. And the thinking about the negativity would be and is that as long rates go up, the long bond becomes more attractive, pulling money away from stocks. And that thinking's been around close to forever, but we have almost now 100 years of history of the S&P and 10-year rates and the correlation, which is 0.33, which is positive. It's not, like you say, it's not 1, which would be 100, or reverse 1, which would be exactly inverse, but it's positive, not negative. Why is your question? And the answer is that, first off, the rising rates get pre-priced the same way the stocks do. Secondarily, as those rates are rising, the actual, and particularly when they're rising steeply like now, the price of the bonds is falling steeply, and money doesn't want to go where the prices are falling. And in reality, then that money wants to think longer term than that short term shift. Another point now that people don't think through, and I've not seen anyone say this, is they all get fixated on this yield curve. And Susan was talking a few moments ago, without saying those words, about that, and how the Fed may push short rates up above long rates, making the normal relationship of a positive upslope between short rates and long rates reverse. The fact that people miss is that 40 years ago and before, time deposits were the basis for making long-term loans, and they made up 65% of bank deposits. Today, they make up 7% of bank deposits and aren't the basis for making long-term loans. Loans with no maturities do that, and those actually have an average basis point of 9 basis points. That's what the banks are getting on them. So they have a huge incentive to lend. What people should pay attention to in terms of yield curve is the spread between short-term and long-term, not 2-year and 10-year, which is what they seem to all be fixated on. And in fact, when you think about that, which nobody seems to think about, this year that spread's been getting wider, not narrower. And there's plenty of room there for the Fed to raise short rates, a la what Susan was talking about, lots of times before you'd ever get close to an inversion. The fact is, just think of that off your 3-year bond and your 9 basis point cost of money to banks. It's really the bank lending that's the force behind what is important or not important about the yield curve, and that's changed sharply over the decades.
So if you're talking between short and really long term, is it short and really long term 2 and 30-year, or what are you looking at, if you're looking at it at all?
30 or 90 days compared to 2 or 10 years. The core business of banking.
Much shorter and more. Oh, got it. All right.
Always been taking in short-term deposits as the basis for making long-term loans. And that's gotten a lot more true in the last 40 years. As money markets have become a non-bank system for other people to get higher yields. It remains true that lending is driven net off the banking system by net outstanding loans, driven by taking in short-term deposits as making long-term loans. And the rising rates, normally what's happened a lot of the time is short rates have gone up before long rates have.
Right.
Sometimes long rates have gone up before short rates have, as they have this time. The correlation when long rates have gone up before short rates is actually much higher than the 0.33. It's actually 0.67 because the fact is that spreads the yield curve that makes the incentives for banks to lend. And with that wider spread, banks make more money off of subsequent loans and they lend more, which provides lubrication to the system and provides lubrication and money going into financials.
All right, well, they might want to lend more in this environment, but are they getting that business? Or is it something that will pan out?
It is something that'll pan out. The banks are actually flush with low interest rate deposits. And the fact is, at one level, and this is the negative part that people don't think about, the more that 30 or 90 day to 2 or 10-year spread widens, the more incentives banks have to lend, the more incentives banks have to lend, the more actual pressure that puts on inflation. What the Fed does sometimes is tries to slow down the train before it gets to the sharp curves, and that's easy to understand. They never want to run it off the tracks. Sometimes they do make mistakes and run it off the tracks, but what they're going to be doing in the short term is actually not doing things to deter inflation, but actually doing things to increase it.
So are you bullish in this environment?
Oh, yeah. No, this is a correction in a bull market. There's so many obvious big fears that are pre-priced. The market is having an almost archetypal stock market correction, meaning a decline of 10% to 20%, but not a bear market, which is a decline off global peaks of more than 20%. This is a near archetypal correction with people all a jitter about all the standard fears, about inflation, interest rates, the war, et cetera, et cetera, et cetera. And yet all of that stuff now is a little bit like digested cud with a cow. It's all in price mode. And as that continues, we're going to see that correction bounce, and the aftermath of these corrections for people that hold on through them and don't sell out thinking that it's a sucker's rally, the aftermath is always deeply positive. And oh, by the way, I'll make the point that after we've had very high inflation, it's also been true, because we've got that same history since 1925, that when you look at, for example, inflation rates year over year over 5%, which are the highest that we have long history of, the fact is that 6-month returns for the S&P 500 have been 4%, 12-month returns have been 14%, and 18-month returns 19%.
Wow.
The fear is a false fear. It's easy to see why people have it, but it's a false mythology, and false mythologies are always bullish. Fear of a false factor is always bullish.
So Ken, when I always argue that people live in their own heads and their own life experiences, and the difference with the backup at interest rates, I know there was alarm expressed when we this week officially averaged 5% plus 30-year fixed rate mortgages. Of course, my wife and I, when we bought our first home, it was at 13.5%, and of course, then we thought we were, financial Nostradamuses. But again, that's our perspective. So we would look at this and say, "Oh, what are you complaining about? That's still incredible." But for a whole generation, and we've had these low rates now, for a very, very long time, it's a jarring development. And I'm wondering if part of your bullish equation here factors in a consumer revolt here, where they stop buying homes, they stop buying, period, because they're scared.
Well, that's another dual-edged sword, Neil, at least in my opinion it is, because what we've seen this year as rates have been going up is that home prices have been going up too. So you've kind of got this one pressure that says, oh, it's costing me too much, and you've got this other pressure that says, but I better buy before the price of the house goes up more. And those are two competitive features, just like the one that I mentioned before about rates rising and bond prices falling.
But both are negative developments, right, for the consumer, right? I mean, if you're trying to buy something that's getting pricier and it's costing you more to finance what's getting pricier, that's a double whammy, right?
Yes, that's all true. But the killer feature that people never think through is that if you just go back to a very long-term history, there is a 4% bandwidth of consumer spending as a percent of GDP, and it never gets outside of that. The theory that consumers drive the economy down is just a false theory. It's the business cycle on the business side that drives the economy down, not consumer spending, and that won't happen this time.
Well, I have you, Ken.
It does
Go ahead.
It does impact consumers negatively for sure.
Right.
It does impact negatively for sure. There's no doubt about that. But the fact of the matter is, markets aren't kind. Markets aren't caring. Markets don't give a darn.
Yeah. Let me switch gears, talk about Elon Musk and this Twitter battle. It looks like Twitter has, started a poison pill. That's not a shock. We haven't heard the complete details, but the stock is barely budging. Of course, today markets are closed, but it barely moved yesterday. It's nowhere near the 54.20 a share that Musk is looking at. And we didn't see any spillover in the technology sphere or NASDAQ 100, or any of these tech ETFs. I'm just wondering what that tells you and what you make of it all.
So I personally don't make too much of it in this way. First, Musk, who is clearly not dumb, is also clearly unpredictable. I have no idea what he will actually do. He can do pretty much whatever he wants. So if he wants to raise the 54, he can. If he doesn't want to, Lord only knows what he's thinking. And in reality, betting against Elon Musk is pretty often a mistake. So I think you got to be thinking you're pretty darn smart to want to bet against him. But what he'll do, I don't have a clue about. And I think anybody that thinks do kind of misses the history of Elon Musk's unpredictability.
Well, he became a multi-billionaire because of it. As of you. Ken, I'm just wondering, though, because I always thought, how does a billionaire finance something? I mean, he's very rich, obviously, but there's the cash flow issue because it's tied up in stock. Now, I'm not here to ask you how you protect your billions. I am curious, though. It depends on how you access that money, if you ever wanted to do so, and whether you leverage against that, take out a margin loan against that. Only reason why I raise it in that context here is that really it could be an important factor here going forward, right? And that gets others involved, either providing that money or that collateral, what have you. I'm just wondering how you think that part works out.
Well, I don't have a history myself of doing acquisitions, as I think you know. I'm not a buyer. I mean, I'm a buyer of securities, but I'm not a buyer of takeovers. And what he has to do that is get money provided, which basically has a ratchet down penalty if he fails. But he can get as much money as he wants relative to his net worth, to the extent that he wants to take the risk that it impacts him. And he's
I guess what it wasn't clear, Ken, I'm sorry to jump on you, my friend, but if he were to withdraw the shares from, let's say, Tesla, I know SpaceX is a little different, it's private, he has a $50 billion stake in that, half the $100 billion. But if he were to take Tesla shares and just sell them outright to raise the $41.3 billion or whatever he needs, that would be more dramatic and maybe a worry for Tesla shareholders than if he were to borrow against them. What do you make of that?
Yeah, and he wouldn't sell them outright. I do not believe. What I believe he would do is borrow against them, and then the ratchet penalty would be if effectively that borrowing forced him to later sell Tesla shares. But in the beginning, if you just borrow the money, at that point in time, he doesn't sell the Tesla shares, everything's fine for a while, and it takes him a while to work through the point of it either being a success or it not being a success as a takeover.
These are problems I don't have, but I just wanted to know from a billionaire's perspective how you would deal with them if you did. But finally, I do want to get your take right now, the tone in Washington, the temperament. Of course, we don't know how the midterms will go. They don't look very good for Democrats, but they have increasingly talked about a wealth tax, going after guys like you to try to raise more money, even singling out the couple of thousand families in this country who are in your league and what have you. How do you feel about all that you're not paying your fair share, not you specifically, Ken, but that this is a fair and right thing to do?
Well, first off, it's a thing that won't happen. So therefore, in my opinion, it's a hypothetical. Trying to create an actual wealth tax, as has been discussed, for people is going to have constitutional problems. And it's not going to get passed in the first place because you have to discern, particularly for somebody like me, what's my worth? And, while Forbes and Bloomberg may say I'm a multi-billionaire, the fact of the matter is that's based on them trying to make guesses about what my firm's worth. And nobody really knows because there's no market there. And most of the wealthiest people in America and the world are that because they own things that are basically illiquid and you can't price precisely. Therefore, putting a tax where some of them own this kind of stuff and some own that kind of stuff gets very unequal among them, and taxing inequality in a single tax is basically unconstitutional.
I lied when I said that was my last question. The Federal Reserve is in the middle of this rate hiking, launch here, and maybe aggressively so. When do you think all that ends?
I think the Fed raises, so we step back for a moment and we think about those long rates for a second. And the long rates have gone up steeply, but compared to the inflation rate, they haven't begun to approach it. And what that said to me almost from the beginning is that the inflation is a more temporary phenomenon, longer term than, let's say, the head of the Fed thought last fall, but shorter term than many want to suppose now. And therefore, I think these rates for a while, then they cut off.
Got it. Ken,
be over there.
We are out of time, my friend. Very good catching up with you. Ken Fisher, the founder, executive chairman, Fisher Investments.